Shannon, let's start with this underperformance. Is there a technical reason for this, or does the underperformance reflect more fundamental issues?
That's a great question. And our view is this was largely driven by technical factors. We did absolutely have a lot of uncertainty coming into the one big beautiful bill, uncertainty around tax exemption, generically speaking, and that pulled forward a lot of supply. That supply just wasn't met by enough buyers. And when we layered in questions around tariffs, concerns around federal spending and pass-throughs to the states, we just did not see enough buyers stepping up to absorb the second year of record supply that we're seeing. So the good news there is fundamentals remain strong, and what we've seen recently is a recovery of that technical sell-off.
So speaking of the federal government, we are in day 30 of this government shutdown. And however this eventually gets resolved, hopefully soon, it is clear that under this administration, there's going to be less federal funding available, including to state budgets. How are you thinking through that? How is the market thinking through that?
Right. To your point, most of the federal funding that comes to states is impacted by the big headline, which is Medicaid. That's about 60% of the revenues that states receive from our federal government. So the cuts there are real, and they're going to be felt pretty swiftly at the state level. They do have a couple years to figure out what they're going to do, and there's really only two opportunities for them. They're either going to need to cut coverage, or they're going to have to make some really difficult decisions in terms of what else in their budget can be cut. And what we've been seeing recently is a very varied response in terms of the political willingness at the state level to make these difficult decisions.
Okay, and one example of that would be California. You say it's kind of the glaring example of a state that does not have a revenue problem, but might have a spending problem, and is at risk of being downgraded.
Absolutely. So California has revenues that are more than 50% higher than they were pre-COVID. So that really supports our view that this is not a revenue problem. Instead, they've essentially ramped up their spending to exceed that revenue. And even on the back of 20+% equity market gains, they're dipping into their reserves. That's not what we want to see during periods of macro strength like this.
So if California does get downgraded, what would that mean for the appeal of its bonds?
Right. So it's important to note this is a AA credit. So we're talking about a credit downgrade from AA to single A, still very, very strong. It's not at risk of, a 28-esque default. That's not what we're talking about. We're talking about a notch downgrade, still very strong. It's just not the behavior we want to see.
Right, right. When might that happen? What will be the catalyst for that happening, do you think, Shannon?
Sure. So we are anticipating it could happen as early as this summer. And because of that, our investments really favor things like local geos, public schools. Those are financed by property taxes, much more reliable, and they're taxpayers are much more likely to support the revenues that back those bonds.
Right. Gotcha. Shannon, before I let you go, what tends to happen in the fourth quarter for munis as we wrap up 2025?
Right. The good news from the technical front is supply tends to dampen a bit here. And that is one of the key reasons that we're pretty constructive that we will continue to see our yields grind tighter, and we should achieve the year of carry for 2025 that we had forecasted.